thank everyone for joining our masterclass today. We have a great masterclass presented by Anthony Millen, and Tian Wong will be hosting as well. We're going to do it kind of fireside chat style today. We're going to do about 30 minutes of presentation, and then we'll use the last 20 plus minutes of Q&A. We will be doing a few polls within the presentation, so just be on the lookout for those. We'll make sure that we announce those, and they're just interactive with the presentation that we're giving. And if you have any questions during the presentation, feel free to write those in the chat, or you can private message them to me, and we will make sure to ask them after during the Q&A portion. And last note is we will be recording this meeting, so if anyone misses any portion of it, or you want to go back and rewatch any of it, or see any of the slides or anything like that, we can make sure to do that. And we'll get that emailed out to you after the presentation. So without further ado, I will introduce Tian Wong and Anthony Millen for today's masterclass.
Thank you so much, Sky, and welcome everybody. Thanks for joining us for today's conversation. Winning strategies for raising money in a brutal market. I think for those of you who are raising, you know exactly what we're talking about here. And we are really thrilled to have an amazing person who can walk us through some of the things that he's seeing in the market and has lots of advice for us. And maybe we could take 2 or 3 minutes to have Anthony Millen talk about his origin story and perspective. Maybe Anthony, you can talk a little bit about your career journey, going from entrepreneur to startup attorney to venture partner in a seed stage VC fund to next powered by Shulman Rogers. So why don't we do that, and that'll sort of set the stage for our program today. Welcome.
Great. Well, thank you, Tian, for having me on today. And just a little bit about my journey. I've been working in the startup ecosystem now for about 30 years. Started my career in big law at a large global New York law firm. And then I jumped into being an entrepreneur. And started several companies. Some were successful. I had an educational health and wellness company I co-founded and was president that grew to about 400 employees and was eventually acquired by a public company that's still around today. And some that did not succeed. And it was often the ones that, you know, a couple of them that didn't succeed, that was where I got my biggest learning experiences and that set the foundation for future ventures. I spent time, as you mentioned, as a venture partner as well in a seed stage fund, and got to see firsthand that side of the startup ecosystem and what seed stage investors look for. And that was also helpful for future ventures and next. And I've spent almost 15 years as a startup attorney working exclusively with startup and emerging growth companies, including at Shulman Rogers, where I've been the founder of Next, powered by Shulman Rogers, bringing kind of all of those different experiences together.
Terrific. So with that background, which is you've seen deals from all different sides, sides of the table, what are sort of the biggest fundraising lesson that you've learned personally?
To me, two big lessons that I've learned are, number one, really focus your time and energy on the part of the process that you can control. There are significant parts of a fundraising process that will be out of your control. But if you focus on what you can control, it keeps and increases the likelihood of success. So, going into the process, make sure you've got a strong executive summary, pitch deck, and financial model. Really practice and practice and practice your pitch. And every time you give a pitch to investors, debrief with your team and iterate to improve from what you've learned. Spend time up front to identify the right type of investor. Don't waste time chasing an investor who you should have known or could have known up front would be the wrong fit. It's really important going into a fundraising round to have a solid legal foundation in place, including all of your legal documents. Your data room and your cap table should be ready. I also think it's really important to have a strong startup attorney who really understands the fundraising process by your side to guide you through each step in that process, and to surround yourself with other advisors, key advisors in other specialty areas that you'll need in the process, like accounting, and as you grow and scale, banking and insurance. The second thing I think that's really important is to be resilient. This is a marathon, not a sprint. Occasionally, you can end up with a fundraising round that goes very quickly, but really it's more of a roller coaster than a straight line, even for people who end up with very large, successful companies.
That's awesome. And as far as, you're unique in that you're an attorney. You're one of the top startup attorneys in the country, and you're also an entrepreneur as an attorney. So what was the impetus for you to found Next, powered by Shulman Rogers?
So as an entrepreneur and in that role, I was seeing that there were really two primary choices on the legal side. One was for early stage startups. One was like a DIY solution that brings affordability, but it comes with big risk of missing something important, or worse, doing something badly or wrong that can have really negative consequences later on. And then on the other side, sophisticated legal services from big law firms, which are incredibly expensive. And now sometimes you have rates of $1,500 to $2,000 an hour for the most senior partners, and unpredictable. And because of that structure, a real lack of regular day-to-day access to the guidance and experience of senior seasoned attorneys. And I really believe there had to be and could be another option that was better aligned to the needs of startup companies. And that was the impetus of Next, which has been built almost as if it's a startup within a law firm, which we launched in 2018 and provide access to dozens of affordable fixed price packages across all the legal areas that wrap in the legal counseling and guidance and strategy and documents from hands-on seasoned lawyers, on senior lawyers on our team. And we enable that with technology. And through that, we've also had experience working with hundreds of startup companies that are going through the fundraising process in the DC region, nationally and globally, and have won Legal Week's award as the best law firm in the US for enabling startup success. So that was really the impetus behind it. And we've also added a new platform, which is called My Next Raise, which helps facilitate investor readiness as well.
Thank you so much. And I want to thank you on behalf of the entire CONNECTpreneur community for everything you're doing to help our early stage companies. I think we have several dozen that are working with Next, and they're loving it. So we can move into the meat of our presentation today. Maybe we can put up our first poll, Skylar. And the first poll is, we'll just sort of give us a kind of an understanding of, who's on the call and, what stages you guys are at. And while the poll is up, I'd like to maybe go from top down and talk a little bit about the fundraising landscape for this year. I know it's been very difficult for many people on this call and for everybody who's raising capital. But from your vantage point, Anthony, what has changed in the last 18 to 24 months?
So I think one of the things to understand is, while it's very hard for founders who are going through the fundraising process, this is an equally hard time in the VC market for VCs. There has not been a lot of liquidity events through either IPOs or M&A activity. So it's very hard for VCs themselves to raise new capital for their funds from LPs. And so what you're seeing is kind of limited dry powder or capital that is available for investing, and of new capital. And for the capital that VCs have, they being extremely careful about how they deploy that capital across their portfolio. And this is being felt particularly hard in available capital and activity in the Series A round. So for many companies coming out of the pandemic who raised very large seed rounds at high valuations, where the model was kind of burning through capital to grow top line revenue, often ignoring break even or profitability to achieve that growth, with the goal then of a big A round to get to profitability or finding themselves in trouble. So that's kind of one major area. We are still seeing a good amount of activity in the seed and pre-seed fundraising market, but with a different focus. So we're seeing more of a focus where there are smaller seed rounds, valuations or caps are lower than they had been, but still, a fair amount of activity. But what the goal of that capital is, and what you want to show investors is that you're using that capital to execute very well on achieving the next set of key milestones, and you have a strong focus on pathway to profitability, where once you hit that point, a lot of different options open up. So those are some of the important changes and lessons that that we're seeing, and some of the dynamics in the marketplace.
Got it. And we have roughly about a third of our audience today is idea or pre-seed stage, about a third seed, and about 20% Series A. So thank you guys for answering the poll. So, one thing we see a lot, Anthony, I know you do too, is how founders, they're always thinking about venture capital, right? Like, I got to get that VC. Some of them are looking for more institutional oriented stuff, but I think a lot of the press and a lot of the touting of deals that get done focus around VCs, even a seed stage VC, or maybe even an A round VC. But there are other sources of financing out there, right? Can you talk about some of that?
Yes. So on the other side of financing, so we'll start off what a lot of people focus on, so in VCs, and when we talk about finding the right VC, you're looking, since a lot of the audience is focused on seed stage, you're looking at seed stage VCs. And what you're looking at there is equity-based financing with safes and convertible notes or priced rounds. We are seeing, for companies who can achieve revenue and free cash flow, we are seeing more discussions around revenue-based models or revenue sharing or cash flow sharing with VCs, where these financing structures include the VC participating in some of that revenue, up to like a fixed return. So we are seeing some other alternative structures in addition to the traditional, more equity-based structures. But in addition, wherever you're located, a lot of states, like in this region, we have TEDCO in Maryland and VIPC in Virginia. A lot of states have state funding organizations and groups that are very active in the seed and pre-seed stage. So that is something to take a close look at. There are angel investors. We're still seeing a lot of early stage deals being done by angels or groups of angels, angel groups. You can also look at accelerators, and a number of accelerators now will include investment dollars along with all of their services that will help in de-risking your business. There's always opportunity to take a look at, some of these have been impacted recently, but an opportunity to look at state and federal grants is another one, like SBIR. We doing more deals through equity crowdfunding. So for certain types of businesses, that is an attractive model for raising capital. If you are generating revenue and selling products, you can pre-sell products and then use that pre-sold revenue to help build some of the platform that you're building. And so customer financing or oriented financing is something else. If you have achieved break even, you can always add to your capital stack a credit line and also receivables. So you really have to look at your company and where you are in the stage and the breadth of options that might be out there for raising capital.
Yeah, I mean, you talk about lots of different resources and different types of money, which is great. Really appreciate that. In terms of like timeless maxims that you might offer in dealing with investors, obviously, if you're going to talk to TEDCO, you're going to have a specific approach to them. If you're going to talk to government SBIR money or an angel group. But generally speaking, do you have any sort of timeless maxims that you can share with us about approaching investors and working with investors?
Sure. And it's really important to think about it from that perspective of not just investors looking at you, but you looking at investors. So one is choose your early investors if you have the luxury and ability to do so very carefully. This is a long-term relationship for early stage companies. You could be working together for 5 to 7 years, sometimes longer. And your early investors are going to be critical components to your future success. So do your research on investors. Focus on investors who invest or have experience investing in your stage of company and also in your market segment. If you're bringing in angel investors, look for angel investors who bring in something above and beyond money. So maybe knowledge of a particular market or some expertise. Same with institutional investors. If they deep in a particular vertical that will help you de-risk, give you access to certain customers, give you access to strategic partners through their relationships in the industry. Do due diligence if you have the ability to on investors. So speak to portfolio CEOs and understand how the investors have been over this period of time to work with, not just in good times, because in good times everything's smooth and rolling along, but every company goes through ups and downs. Even these billion-dollar companies you see today, most of them had periods where it was tenuous at best. And so during those downturns or those tough times when you're struggling and pushing through and persevering, how were the investors to work with at that point in time? How did they step up to the plate to really help bring you through those lows that the company was going through? Get in front of investors early. And so what I mean there is even sometimes before you're ready to start a raise, you can start getting in front of investors before you need money from them. Investors are always looking for interesting new companies and great new teams. And so if you can get in front of investors early when you're not asking them for anything, and you can get them excited in your team and your product or your service, and you can share information with them as you're hitting new milestones, as you're making progress, that is a great way to be ready when you're ready for the funding to have built that relationship. And it helps the investors as well. And so often your investors will say to us, I love who we've made an introduction. I love the team. I love the company. I just want to see their progress for a couple of quarters. So facilitate this and get that information clearly to investors and be ready. It's helpful if you have the ability to have a few investors filling around because it gives you more option to find one who will be willing and able to step up in future rounds. And that's a strong signal, right? When your existing investors participate in a new round, that's a strong signal to the market. So, and also sometimes you just need your existing investors when you need to hit that next milestone and you're really close to bridge you to that next round. So having a few gives you that as well. And always keep your investors informed. During good times, during bad times, always keep your investors informed. Never surprise them.
Love that last point. I would even say not only keep your investors informed, keep your potential investors informed and all your stakeholders informed, because you never know how people can help you. And as all of us who have been through the startup journey know, it takes a village.
Yeah.
Let's put up poll number 2, Sky. Our second poll here, just to get an idea. We got about a third of you are pre-seed, a third seed, 20% A. Just kind of give us an idea of how much you're raising. While I turn to our next kind of segment here, Anthony, what can founders try to control in the process? I know that a big piece of it is being investor ready from a legal perspective. And I'd love you to just talk a little bit about that, because I feel like that part of things is very often overlooked. They're going to do legal Zoom, or they're going to not document things properly, whether it's a buy sell or a partnership agreement or even a fundraising agreement. I'm just talking at the very top of the iceberg, but what are some sort of can you talk a little bit about being ready from a legal perspective,
Sure.
investor ready? Thank you.
Sure. So one area is just when you're going out for raising funding, having a legal entity structure that's conducive to the round that you're trying to raise. So often companies will start as an LLC and may not be a C Corp at the point that they're going out to raise money. So kind of understanding, should you be an LLC, should you be a C Corp, and when should you pull the trigger, for instance, to move from one to the other, and understand that investors, particularly institutional investors, will prefer a C Corp for a number of reasons. If you're building a growing company, having an equity incentive plan in a C Corp provides for incentive stock options or ISOs for employees. It's also more familiar for your employees to get stock options versus unit appreciation rights in an LLC. And if you're a C Corp, you may be eligible to be a qualified small business stock, have qualified small business stock under Section 1202. And if it's qualified and you hold for at least 5 years, before you exit, $10 million of capital gains for stockholders who meet requirements are excluded. So there are a number of reasons for looking at that as you're going into the fundraising process. We also, a lot of times, somebody has got an investor ready to invest, and they come to us at the last minute saying the investor wants us to be a Delaware C Corp, to be in Delaware before they invest, and we kind of last minute scrambling to either redomesticate them or move them in. And so their reasons: Delaware is very established, their precedents are well established, it's predictable. Investors, because most of their portfolio is in Delaware, will have all their document sets based on Delaware, so there's less transactional costs and friction, and also kind of very rapid turnaround capabilities in Delaware. The next big area, Tien, when you're talking about what you can do as you're getting ready to give yourself a better chance in this environment for raising funding, is on the founder side. And so on the founder side, you really want to, at the beginning of your fundraising process, if they're co-founders, really make sure your allocation between the founders is optimized and correct. It gets much harder as the company grows in value to change that. And you want to make sure, we see a lot of times where founders are building up momentum, they're getting ready to go out to do a fundraise, and suddenly there's a founder dispute or one of the founders leaves. And that situation can have a huge impact on a successful raise with the investors you're in the process of talking to or who are tracking the company, and it can be fatal to the process and to the startup. So really make sure up front you have alignment between the co-founders. We see this a lot in terms of the type of company you want to build, the mission, the vision. Are you taking outside capital? How much? How fast do you want to grow? How risky a growth climb do you want to make? How much time are you committing each of the founders? How many dollars or how much dollars are being committed? The next thing we see a lot of is vesting shares. And so when you have multiple founders, if one founder leaves after 6 months or a year, they may leave with half the company or 30% of the company if they're 3 founders. And that also is very challenging. So you want to make sure to have that in order. It's something you can control. The investors are going to want to see that as well, that you have that in place. So you shouldn't be rushing to do that at the last minute as you're in due diligence with investors. And you want to set that up as reverse vesting, where you get the shares up front so you could take advantage of 1202 and other tax benefits. And you have to remember also that if it's vesting, you've got a very short time period, 30 days, to do an 83B election. Investors look for that in the due diligence documents, and there's significant negative tax implications if you're not. And then when you do have a co-founder leaving, you want to make sure all the IP has been assigned to the company. You have all the releases and covenants in place, so that when investors look for those documents in due diligence, they're going to be there. And finally, you need a cap table that's going to make sense to investors. And so you want to have ownership where somebody who left is now still owns 50% of the business would make no sense to future investors. They'd view that as a out of sync cap table that would pose challenges to the round.
Yeah, got it. If you can go a little bit deeper on cap tables, data rooms, and due diligence, that would be helpful, I think.
Yeah, so cap tables are foundational when you're getting ready to raise a round of funding. They need to reflect in a rock solid way all the securities, your preferred stock, your common stock, your safes, your notes, your warrants, your employee options. There should be nothing that you've promised to consultants or advisors or anyone who's working with you early on who you haven't papered and documented, who you owe shares to, or who there is evidence you owe shares to that is not reflected in your cap table. It's really foundational and critical at the beginning. Same with your data room. You know that you're going to be put through due diligence when you get into speaking with investors. So from day one, have your data room set up. Have every legal document in there that's correct and executed, and have the organizational structure of your data room match the way an investor would want to be able to go through it. You don't want to disappear for 2 weeks when an investor is interested in giving you a due diligence checklist and suddenly start getting your data room ready. And then in due diligence, remember there's business and financial and legal. Investors are going to go through all of the documents or their lawyers in the legal due diligence. And this is a time for you to either build confidence because everything in due diligence is going so smoothly, or if things are disorganized or you're delayed in responding to due diligence requests, you're throwing up red flags where an investor would say, what they're showing me, what the founder is showing me has all these problems and delays. What happens to what they don't show me? What am I missing?
You've thrown around a lot of terminology with respect to, different types of securities that can be used. Safes, convertibles, price rounds, Series C preferred warrants. Can you talk a little bit about that?
Yeah, it's really important to understand as a founder when you're going into raising funding what the tools are. What are the securities that you're going to be negotiating with investors over? So in pre-seed and seed rounds, you're often looking at safes, convertible notes. So most of them are done through safes now. The majority of the early stage funding that we do are safes. We're still seeing some convertible notes, and some investors will only use convertible notes. Then as you get into larger raises, usually around 3 million or more, you start seeing that from a transactional cost point of view, it makes sense to do price rounds if that's what the investors want. That's when you're issuing preferred stock. So in a seed round, it's a seed preferred stock, and in an A round, it's Series A preferred stock. And there you have many more legal documents. It's much more transactionally complex. And then also you may see in your term sheet that you get from investors something showing up called a warrant. And so that is something that sometimes is included as a kicker or an extra incentive, or with strategic investors. So you as founders have to take on to understand the difference and the benefits of each of these different types of securities. The investors live and breathe these securities. They know them inside and out. And so you need to kind of understand that as well. And a lot of investors founders spend a lot of time focusing on valuation and valuation caps. But each of these different structures come with certain rights and preferences and protective provisions that the investors also spend a lot of time thinking about that may have even bigger impact on you running your business as you grow your company. And so having an understanding of those or an advisor by your side during those is really important as well. And remember that whenever you're raising money, and investors are going to look for this when they do due diligence, whenever you've raised money, there are security regulations you have to comply with, whether it's the Security and Exchange Commission filing a Reg D or state security agencies, and whether you've raised a friends and family round and you've raised or a seed round and you've done it through a safe or a convertible note or preferred stock, you always have that obligation, and it's something that has very time sensitive in terms of number of days from first close that you have to comply.
I mean, it's a really complicated process. It doesn't look like that on the surface. But before we go to question and answer, because we want to reserve, 20, 25 minutes for our audience to ask questions. And by the way, if you have questions, you can direct message Skylar or just put the questions into the chat box and she'll be moderating the Q&A portion. But Anthony, any final sort of pieces of advice, any thoughts, anything to keep in mind before we go into Q&A, if you're out there raising?
Yeah, in summary, the big things again are understanding if you're raising funding, not only the securities, but when you're stacking safes, and like right now, often because it's so hard to get to an A round, people will do multiple safes and convertible notes, multiple seed rounds, each one with its own caps. So really understanding how each of those stack and what's going to happen when you eventually do a priced round to all of those securities and the dilutive impact. As you bring in money, you will own less of your company if it's dilutive capital. But if the value of the business is going up, you just own a smaller portion of a much more valuable company. So it's accretive to you in value. But either way, you need to understand and model out or have help from your startup attorneys or other people you're working with to model that out. Which is why it's really important, like I said, to have a strong startup attorney at your side. And then also understand your runway under the most pessimistic assumptions. Pick your worst case scenario and make sure you have enough money that you're raising to get to that next core set of milestones that you need to achieve. You don't want to mid milestones be running out of capital before you get there. That's when there's a lot of negative impact to the company. So really understand your 12-month, 18-month burn rate to the dollar under the worst case scenarios, and make sure you're raising enough to get to that next round.
Great stuff. And if we could put up our third poll, Sky, we can these are sort of legal cap table issues that you guys may have encountered in the past. We are going to open up for Q&A in about a minute or two. I just want Anthony to talk a little bit about how can people learn more about what Next and My Next Raise are doing, and how can they get a hold of you?
Great. So if you go to next.law, that is the website for Next, powered by Shulman Rogers, you can learn more about us. Through that website, you can schedule a free introductory call with me. Always happy to learn about what you're doing and answer some questions you may have. And for My Next Raise, which is our new platform around investor readiness, that is you can access at mynextraise.com. So both next.law and mynextraise.com, and either request or schedule a meeting through those, or request us to follow up with you.
Got it. And just looking at the poll, it looks like half of our audience have not had legal or cap table issues, and about a quarter have had them. But it seems like of that group, 2/3 have been able to get through them relatively easily. I'd love to turn things over to Skylar. Why don't we run our last poll right now?
Yeah,
And that's
yeah, definitely.
for those of you. And I'll turn over to Sky, who I'm sure we've got lots of questions for Anthony. Again, thank you guys for joining us, and I'll turn it over to Sky.
Yeah, no problem. So like Tan said, I put up that last poll. I'll leave that one up for a couple minutes. And feel free to answer that as we get into Q&A. Our first question says, Anthony, you mentioned de-risking multiple times. Can you talk for a minute about de-risking a startup?
Right. So when an investor looks at a startup company, they're looking at a number of a founder, and as a founder, and I've been there as a founder, right? As a founder, we're always looking at all the upside and how big a company we can build and this incredible problem we're solving and our solution for solving it. The investors are looking at risks in addition to that. So they're looking at execution risk and at the team. They're looking at market risk, so product market fit and the risk of finding that. They're looking at technology risk. If it's a technology-oriented solution or platform, what is the technology risk? And then they're looking at capital risk, like the risk of not having enough capital to execute on your plan. And at different phases of growing your company, people are looking for certain of those risks to continue to be addressed. And as you address them, the company becomes more and more valuable. So with execution risk, you have an ability to the founders to add advisors who maybe have built companies or have deep industry knowledge or deep knowledge of the problem that you're solving for. And you can surround yourself with a team of advisors or add on another co-founder in an area that you're weaker in, right? That's one way to deal with execution risk. Product market fit is something you have to keep iterating, but investors different investors will step in once you find product market fit, because then it means you have a problem that you're solving for, you've built a solution, the market has recognized your solution as something that solves their problem and sees value in it. You're able to charge money and generate revenue from putting that into the hands of your customers. And you can charge money in a business model that allows you to generate profit while doing that. And so as you start showing that customers are willing to buy it and use it, and they're using more and more of it, and I'm growing the number of customers and I'm lowering my customer acquisition cost, you're dealing with that. Capital risk, like I said, is just making sure you really can show the investors that as you grow the company from where you are now to that next set of milestones, you will have enough capital to get you there, and that you're raising enough money, because both you and the investors get hurt badly if you run out. And again, technology risk is something that as you prove your technology works and is stable and is scalable, you're able to show that you've kind of de-risked that. And that's really what it's about. You're taking money and you're achieving these next set of milestones. You're eliminating some of the risk that the investor was concerned about, and that's driving up the value of your company.
Okay. Our next question is, what can we expect and not expect from an experienced startup attorney?
It's a great question. The most important is to realize that the same as if you have a heart problem, you're not going to an orthopedist or an orthopedic surgeon to address that. There are different attorneys. Not all attorneys are the same. So one thing is there is a pace and there is a language and there is market trends and what's market and not market, all of that go along with the startup space. So first of all, you want an attorney like you would want a physician who really specializes in working with startups. The second, during the early phases, is you're going to want an attorney who can work at your pace, at the pace of a startup. Being a founder is 24/7. You're never stopping. You're never going away. Things are really time sensitive, and sometimes the impact of time can be the difference between an investor walking away or not walking away. So being able to work at the pace of a startup. being somebody who's in the startup ecosystem, so that as you need an accounting firm or a bank or a 409A valuation or D&O insurance, they have the ability to make introductions to exactly the right people at the right time is something else. And then also they have a network of investors who they have relationships with, who are looking for new companies, who they can help make connections and introductions to. You know, as an example, through My Next Raise, we do a founder funder events 4 times a year. We set up 260 one-on-one meetings last year between founders and investors through that platform. So those are the kind of things you're looking for, is experience, pace, and finally, it has to be affordable. It has to be flexible. As a founder, you have a finite amount of dollars and they can't all go to legal. And you need a lawyer to understand that. You're building a product, you're building a team, you're building, you need to put money into marketing and getting product market fit. There's only a finite amount that could be allocated to legal, and helping you understand and prioritize what's most important now, what can be done maybe not at the same level today, but you can catch up after your next round. So having that sensitivity and that understanding is really important as well, and that they're willing to be a long-term partner and with you from launch through exit every step of the way.
Okay. Our next question says, you mentioned founders leaving the company with vested equity. How much dilution from a departed founder is acceptable for a seed deal before it becomes a major red flag for investors?
So one of the things, this happens a lot. We have founders who are leaving. The key is you want to show that there is significant equity for the founders who haven't left, who to motivate them to spend the next 5 to 7 years building their business. So it can be a little bit different in different situations, but what you want to negotiate with a departing founder is a structure that gives them some, especially if they haven't been there that long. So if a founder leaves with 5%, somebody leaves with 5% or 10%, so that they're not leaving with 30 or 40, you want to try to negotiate with the departing founder so that if this ends up being a really big business, they're going to have enough of a stake to do well. And they're going on often to do a job where they're not taking the same amount of risk. They're doing something different. You're staying with the rest of your team, putting 24/7 into building it. So you need to kind of find that balance where it's enough to give somebody real upside if this is, becomes a centimillion or billion-dollar business, but that the founders who are staying, especially as you dilute down with new equity that comes in, are fully incented to stick it out.
Okay. Next question. Do you recommend any changes to the basis Y Combinator safe note, and why?
The Y Combinator safe note is now used in many deals when people do it on their own. There are certain things that sometimes investors may or founders may look for, but it is a solid foundation. The key though is that understanding when you're working in a round with investors, there's a lot that goes above and beyond just the documents. There are documents that you can download and use, but negotiating with investors, understanding what they're looking for, dealing with investors who may not be familiar with safes, deciding whether to use a discount and a cap or just a cap, or where that cap may be, or whether people who own, what happens when you're generating a lot of money. You have a business that's throwing off so much cash that there's no maturity, like in a convertible note where there's a maturity date, you don't need more money. And so that safe is just sitting there and you don't do another round because you're generating so much capital. How do you address that scenario? So I think a lot of people use it. I do think that regardless of whatever documents you use, whether you use something like it or a slight version or something that's slightly changed, having somebody guide you through the process is really helpful. But, I think it's part of the reason why so many early stage deals now are done through safes, is just because it's very commonly used.
Okay. What is a good source of data for setting safe caps and valuations?
There are a couple of places who put out information. One good one is Carta, has a lot of companies that are in there, and they have data on valuations and valuation caps. PitchBook is another organization, although sometimes that could be quite expensive, but they have information on certain valuations of rounds. But remember that at the end of the day, a valuation cap is people are going to be looking at a few core things. They're going to be looking at how strong is in the early stages where you don't have a lot of revenue or other information to go on. They're going to be looking at how strong is this team, because businesses may pivot, markets may change, but often in the early stage, you're betting on the team. So how strong, how experienced, how well does this team understand their market is one big area. Another thing that investors are going to look at in looking at the cap is how big is this opportunity? If this team is right and they can execute on this particular business, how big a business is this? Is this a $50 million business opportunity, a $500 million, a $5 billion opportunity? So they're looking at that. They're also looking at traction. So have you de-risked technology risk like we talked about? Have you got product market fit? Is there a little bit of revenue? So the number is going to be, it's a negotiated valuation that you're going to negotiate. You're going to work with advisors who are working around you, who are seeing a lot of what's happening in the market based on those variables that investors are looking at. And you're going to come up with what you think and understand is a cap that you're comfortable putting out in front of investors and feel you can justify and explain. And then there's a negotiation between you and the investors. And if it's an oversubscribed round, it may move up. If you're struggling to raise money at that cap and investors are saying we love everything but the cap, it may move down. But you can look at that data, but you can't peel away from that data the specifics of each business. It's bespoke to that particular business, and looking at those variables together with advisors to come up with the cap that makes the most sense for you within the range that you're seeing, because sometimes the range can be fairly wide.
Okay. How do you protect from investors fishing for information only to help one of their other investments? NDA only helps if you catch them disclosing to another party.
When we said getting to know your investors, when you're dealing with angel investors and some angel groups, you may have NDAs. A lot of VC funds will refuse to, or be very hesitant, or will not sign NDAs. And so really understanding the reputation of the investors group is one thing. If you're an investor who's kind of taking information from companies and giving them to your portfolio companies, and word gets out, that can end the VC fund from a reputational point of view. But at the same time, you also, as you're working with investors, you can stage what you release. So as you're spending more time in there, investing more and more time and money in due diligence, and you can see this is not just a kind of fishing exercise, you can start to release more information with them. So you don't have to show everything, full financial models, all customer detail. You can stage it as you need to show enough to get people interested. And as you see investors digging deeper and deeper with real money and real time, which is a really scarce resource for investors is time into the process, you may do that. But NDAs with, particularly with VCs, is very tough.
Okay. Is it advised to raise from international markets? My company is based in India and we are planning to pitch to investors in US and UK. Based on your experience, can you share some thoughts?
Yes, so raising, whether you're, if you're an international company raising from US investors, one of the things we see investors wanting, and it's totally fine. And the US is a really strong market, right? And a leading market in the world for raising capital. But what investors will often want is to see you set up a Delaware parent company. It's called the Delaware Flip. It's one of the things, just as an example, at Next we offer fixed price packages for. But what that involves is taking your company, for instance, in India, and setting up a new Delaware C Corp and moving your international company to be a wholly owned subsidiary of that, and then raising money, which is what the US investors will want to see for this new structure, by bringing that money into the Delaware parent. So we see a lot of international companies raising money, keeping their local company as an operating business in the UK or in India or wherever in the world you're doing that. You have local counsel who's looking at the issues, both the securities issues and the corporate issues in both jurisdictions. But it is very common, and we see that a lot. We're regularly working with international startup companies doing this kind of structure, this Delaware flip structure, as a way to raise capital from US investment community.
Okay. Could you talk more about the challenges of raising a Series A and why some founders are leaning toward doing multiple seed rounds?
Yeah, so as we spoke about at the beginning, there's just less Series A capital available. So that particular tranche of venture capital, as we speak to a number of investors in the VC community, because there hasn't been a lot of liquidity, we spoke about a little earlier, there's not been a lot of liquidity events where, in the way VCs make money is when your startup company goes public or is acquired, they're able to return capital and return on that capital profits to their investors, right? VCs raise money from their investors called LPs, limited partners, who are investing in the VC fund, who's then deploying that capital against a particular strategy or thesis. And since they don't have a lot of liquidity, people who were doing Series A rounds and going out to raise another Series A round are not being, there's a small number of investors who are raising mega multi-billion dollar rounds, but the market generally is harder for VCs to raise new capital to put into Series A. And therefore, they're also being very careful with how they deploy the capital they do have left in their fund, since they're not or struggling to raise new funds, how they deploy that capital within their portfolios. So what basically happens then is, it used to be you raised the C round, you executed, then you went to your A. Now you raise, just say, 750,000 or $1 million seed round, right? And you're executing and you're doing well, but you haven't quite gotten to the point that a Series A investor, because what they're looking for now that there's smaller pools of capital is they want you to be, not only revenue, but revenue with the pathway or with profitability. And so, where you are in your growth cycle means you need to get further along. So how do you fuel yourself to get further along? And so you may do one seed round where you haven't added a huge amount of value yet, so you don't raise too much money, or you decide not to raise too much money because of the dilutive impact. So you don't want to raise 3 million upfront because you're just starting, for instance. So you raise 750 or 1 million or 1.5 million, and you execute. And you can show investors that you're executing and you're kind of ready for that next set of milestones, but you haven't reached the milestones a Series A investor will look for, then either your existing investors or your existing investors plus new investors might do, you do one safe, like a Series 1 safe, and then you do a Series 2 safe or a second safe. So, and then somebody comes along and they want to do a convertible note because they don't want to do a safe in your next round, and that's all you can get. So then you do a convertible note. So sometimes you're seeing companies that have 2 or 3 or 4 seed rounds before, because the A investors are moving to the right in terms of what they're looking for. You have to do more seed rounds to achieve those sets of milestones that get you there. And that's when we talked about understanding the impact of these different seed rounds. And also that's when we talked about refocusing a little bit on not just how do I go through money and grow and still lose money, but how do I have an eye on getting to profitability, or at least a pathway to profitability sooner, which maybe makes it easier for an A round as well as other non-dilutive sources of capital. So that is part of the dynamic that is changing for founders as to not only how they raise money and how much they raise, but what their goals and objectives are going to be as they go towards that raise.
Okay, wonderful. Thank you, Anthony. And I know we have just a few more minutes left, so I'll ask probably just one more question. What is your best advice to founders to plan an exit strategy that will bring them rewards fastest?
I've always said it's very hard to focus on the exit. You got to focus on the execution. If you can build a valuable company that is executing, that is year on year growing, that has achieved profitability, and that profit is growing and your margins are growing, and you've established a strong brand and strong leadership, the exit events through M&A will take place on their own, like they'll take place on their own. And so it's very hard when on day one you're already planning for an exit. I always focus more and believe you should be focusing more on how do you build a really valuable, profitable, growing business. And that way, once you've done that, there will be many options. There'll be strategic exits through to strategic buyers who look to early stage companies that have reached that point for future innovation, because it's harder the bigger you get to do that innovation. So, there's a whole, all of these corporations and conglomerates have groups who look for startup companies that are innovating and that have achieved that. And secondly, they're financial buyers, so private equity funds and groups who look to buy those kinds of companies. So it's all about the execution and building value with the money that you've raised and achieving the milestones you told your investors you were going to achieve with their money, and having the right endpoints and goals around what you're trying to achieve on that funding as you execute.
Okay, awesome. I know we had a couple questions in the chat about the meeting recording. I do want to let everyone know that this recording will be emailed to you after this event, so you'll be able to look back at it or share it with anyone who might find it beneficial. But I do want to give a big thank you to Anthony Millen today. He has been awesome, and I know we had even more questions in the chat. And we'll make sure to connect everyone with Anthony so that if you want to get with him to ask some questions, you can do that as well. Other than that, I think we can end the meeting here, and I hope everyone has a great weekend and happy Friday.
Great. Thank you
Thanks
so
so
much,
much, Sky. Thank you, Anthony. You're the best. And everybody, thanks for joining us, and stay tuned for information on our next events and masterclasses. Thank you so much. Have a great day.